Karl Siegling, welcome to Eureka Report. Thanks for coming in.
Thanks, Alan. Thanks for inviting us.
Now look, we know about the power of compound interest, the difference between like 6 or 7% return and 10 or 12% and then even 15% return, which can be enormous over the course of a lifetime, obviously, even over the course of 10 years. But the question is, can an investor expect to get 10 or 12 or even 15% returns over a long period of time without taking too much risk?
Yeah, I think, Alan, what I always tell my shareholders is equity markets tend to, in the long run, do 10 to 12% per annum. Now, of course, we're in a funny situation at the moment because we've had a global financial crisis where the equities markets fell 50%, and then just to recover, you have to have nearly 100% return to end up back where you were. Australia hasn't experienced that yet. So probably if you slice it in 5 or 10 year periods, you get totally different returns. But I think over the long term, I always indicate to people we're looking for 10 to 12% return in equities. Otherwise, you wouldn't take the risk.
Yeah. And so what's been, in Cadence Capital, you've been going for how long now, 10 years?
We've been 9 years listed, and our unlisted vehicle's been going for 10.5 years.
And how much of your money is in that? I mean,
have
you got your money in that
I've got nearly all of my money invested in our funds. So that's a very important part of the equation when people are looking to invest with us, or conversely, when I'm looking to invest in other people's businesses, I want to know that they have skin in the game, that they have a big percentage of their own money tied up in the fund. That's an important piece of the puzzle.
So what's
especially from a conflicts of interest point of view.
So what's been your return over 9 years?
Well, we're 18% per annum gross. Our listed vehicle then pays tax on that money, and we pay that out to people as fully franked dividends.
So what's your net return?
The net return, well, you'd pay 30% on your 18% and a 1% management fee. It's about 14 or 15% per annum. And that's over a period when the All Ords has done 6% before tax. So if you tax that number, you end up at about, 4.5%.
So what we're here today to do is to tell our subscribers how you do that. What do you have to do in order to get double the market return?
Well, let's talk about how things are traditionally done, because I think that would be interesting to people as well. What usually happens is you put your money with a super fund, and that the asset allocators and consultants and dealer groups and planners and the whole chain of people involved in managing your money then tend to go and put that into an index hugging or an index style product. And I've just indicated that over 9 years the All Ords has done 6% per annum, so you get your 6% per annum because you're basically got the index, and then you pay 1.5 to 2% fees.
Each of those people you've mentioned,
everyone has to get paid. Everyone has to get paid. So along the way, everyone gets paid. So then you pay about 2% fees in total for that advice. So your 6% becomes 4%. Then you pay your tax on your 4%, and you're done at 2.8% return. So that tends to be what happens. But now what we do is we cut out all those middlemen disappear because we're a listed investment company. So if you decide you're going to put some of your super money into my fund, you just buy the shares, CDM shares on the ASX, and you then own those shares. We charge a 1% management fee on that. So one piece of the equation is we immediately get rid of 2% fees.
Now listen,
now the second
we're not just here to give Cadence a plug. We want you to give us your secrets.
Okay, so and the second part of it then is that we simply do not just hug the index. We're looking for opportunities, and most often the opportunities that yield the highest return, as with everything in life, are outside where everyone's looking. So everyone's looking in the index, the top 100 or 200 stocks. The opportunities are outside the top 100 or 200 stocks. And we're not just plugging me, we're plugging the whole industry of people that are not hugging the index here. So there's a whole group of people that are trying to outperform the index. Actually, psychologically, and even from a theoretical academic point of view, there's a whole group of people that would say you can't outperform the index. So if someone says that to me, I obviously refute that claim. I think you can definitely outperform the index because everyone's just hugging the index. So we're looking for opportunities truly that are cheap and expensive. So the best way to describe that is we have an open mandate. So we can look for anything we want within the 2,183 stocks listed on the stock exchange. So there aren't that many good opportunities in any given year. We estimate there's about 35 to 40 good opportunities a year, and they're very often not inside the top 200 stocks. That's the key. So you go around looking at
35 to 40 opportunities
per year. Remember, only 700 of the companies listed in Australia actually make a profit. So the other 1,500 are actually making a loss. So you don't
But
actually
it's okay
have a
to
big
invest
pool.
in a loss-making company sometimes, isn't it?
I
Or
like
do you,
to say
do you not do that?
that terminology you just used, to invest in a loss-making company, I'd prefer to say it's okay to take a punt or take a calculated risk or speculate on a company that doesn't make money. But when it comes to investing, I like to look at companies that have cash flow and real earnings, because in the end, in our view at least, the business is in existence on the stock exchange in most cases to produce a fully franked dividend return and a capital gains tax for their clients. But no, there's obviously a speculative element to our market, a very big speculative element to our market when you include resources, because a large part of the venture capital industry started here based on resources.
That's right.
Yeah,
That's right. So tell us about how you go about finding the opportunities.
So what we do is we visit 300 to 400 companies a year. That number's increasing now that there's a team of 3 portfolio managers doing the work and a risk manager. We're visiting probably 500 to 600 companies a year now. And we're going there and we're trying to determine what their earnings is. What are their actual earnings? How do they actually make money? It's actually not as difficult as it appears. Most businesses make their earnings in 1 or 2 areas, and they have 4 or 5, maybe 3 or 4 key business drivers that drive that business. And then you try to determine what the earnings growth is going to be for the next 2 years. Once you've worked that out, you look for a relative valuation of the business. You look at their cash levels, their debt levels, and their relative operating cash flow and free cash yield based on their market cap. Everything I just described then sounds like a little bit complicated, but it all fits on an A4 page if you write it down with a paper and pen. And that's our starting point. And from there, we decide either to invest in something cheap, and if we do find something cheap, we put 1% of the fund into it. Then if it goes up in value, we add another 1% and another 1%. We call what we call scale into our positions. So a position starts small and gets to a maximum of 5% in a portfolio.
Right.
So yeah, that's honed over many years, that process.
So if you find an opportunity, if you find a good company,
yeah,
you don't just go, bang, I'm going to invest in it.
No.
You put a very small amount in,
no.
and as it rises,
Well,
if it rises, you buy more of it.
See, at any moment in time, you might think something's good. I'll use a great example. Maybe 5, 6 years ago or 7 years ago, you might have thought an iron ore company was a great company. People were telling you it was a resource boom, stronger for longer, stronger forever, China, India, Chindia, we all know the story. Then it all just ended. So no one rang the bell to say when it was all going to end and iron ore companies were going to be terrible investments. But so you've got to start with a small position based on the knowledge that you have. Because remember, your knowledge is not perfect. No one's knowledge is perfect when we're investing. And then you scale into the position as the scenario unfolds as being correct. That's actually one of the key differentiators of how we invest money. And the thing that I always try to tell anyone that invests money to focus on. Because if you...
To focus on what?
To focus on being risk adjusted. You know, put 1% in, then another 1%, then another 1%. The thing that I notice with a lot of people that start off investing for the first time, they'll put 20% of their money into one position, or they'll put 10% of their money into one idea. That's a big risk. That's
called conviction investing, right?
Yeah, and why have strong conviction initially? Why not have a small position and then add to it as it goes your way?
This is all very well, but this is your job, right?
Correct.
Can anybody who has another job, who's investing, do that? Because nobody can visit those companies. Can you do what you're talking about without visiting companies?
In my view, the basics of it, most people can do. For example, if I sat someone down for an hour or two and said to them, listen, don't put 20% of your investments initially into one position. The one that I always say to people, if you're investing for the first time in your life, do not take out a margin loan. Hey, what do you know about investing the first day you come to invest in your first stock? The correct answer should be nothing. Okay, you might have an academic, you might have read something about it, you might have heard someone say something about it, but you actually have never done it. So the first thing is, don't borrow money to do it. The second thing is, take small positions and grow into them and learn from what you're doing. And I think that almost anyone can do this. The difference between someone that does it like us daily and if it's not your job is you have to adapt your systems, which is, you can't have a system if you have another job where you've got to trade the movement of a price during the day, because you don't have access to prices during the day. You just adapt your system to, looking at prices at the beginning of the day, prices at the end of the day, or prices at the beginning of the week, prices at the end of the week. And so you can easily adapt the system to suit your circumstances. And I think a lot of people are. Like, for example, the self-managed super fund phenomenon, as I call it, when I started 10 years ago, there was 25 billion of self-managed super, and there's now 500 billion. It's going to be 1.5 trillion in the next 7 years. People are clearly taking on a bigger portion of the investment process themselves.
They are.
Yeah.
And one of the issues for them to think about is the past versus the future. So your returns over the past
Correct.
9 years
Yep.
are 15% net, right? 18% gross.
Yep.
And this kind of applies to everybody in your game.
Yes.
How does one come up with somebody who's going to make 15% for the next 10 years?
So that actually is very, very difficult. In the same difficulty that a self-managed super fund has trying to find a fund manager that can produce consistent returns is the difficulty we have finding companies that can provide a consistent return over time. Companies tend to be quite cyclical in their earnings.
You're right, it's the same thing, isn't it?
It's the same process.
It's the same process. So
except there's not as many choices. If you asked me, if I had to think about your range of opportunities for a self-managed super fund, if they were going to put money with a fund manager, they've probably got 100 or 200 realistic opportunities that they could get into easily, that once they had assessed the performance of that company and how that company had done over time, there's probably 100 or 200, and they've got to start covering them in more detail. Then they'll probably get that down to 20 to 25 in fund managers, and then there'd be probably in the end 5 or 10 that they'd like to track over a long period of time and potentially start to put money in. Much in the same way I just said, you wouldn't put all your money with a fund manager, you'd put 5% with it, maybe 1%, but the fund manager is different because they already have a diversified portfolio. So you put 5% of your self-managed super with one fund and then grow.
I suppose what I'm asking is, how does one assess the past in order to predict the future?
Very, very difficult. That is a very, very difficult process, and often one that, every disclaimer of anyone in almost any field of endeavour says the past is no indication of the future. However, what can we say? We can say people that have a lot of their own money in their own businesses, a lot of their own money in their own funds, and have a strong vested interest to make sure that those funds perform. People that actually have a rapport with the person whose money they invest tend to have better alignment because they know the person. We're now not talking about a whole group of faceless people in a crowd that are managing your money. This is actually quite a good question. Do you know who is managing your money right now? If you don't, that's probably not a really good sign. So it's probably good to, over time,
individually, not just the company, the
individual who's
making the decisions about your money.
Who's making the decision about your super right now? That's always an interesting question. And then there's that ongoing issue of alignment of interests. People get paid, funds managers, myself included, we get paid to manage people's money. We get paid a 1% management fee. And if we outperform, we can earn a performance fee. Now, the industry has a really ambiguous response to people that earn a performance fee. Some people say, oh, well, that's just terrible that they can earn a performance fee. So my answer always, and my philosophy on this is, if you can't pay a manager to outperform, he won't outperform. If you tell someone what to do, they will diligently go and do what you told them to do. So if you want them to hug an index, they'll hug it for you all day long. But if you want someone to outperform, that requires incentive to outperform.
And you have to pay them for outperformance.
Pay them to outperform.
Okay, so that's an interesting rule of thumb, that really you should be looking for somebody who's firstly got their money in the fund, secondly is paid a performance fee.
Correct. I think in the end, if you're looking to outperform the index, then you should look for someone to pay a performance fee. But then more recently, I've also been saying to people, as the industry's evolved and self-managed super has become such a big portion of the industry, if you can't achieve all of that, you're better off just buying an exchange traded fund. You're better off just paying to get the index at the lowest price you can. I mean, I don't get paid by exchange traded fund people to say that to say that in the newspaper or talk about that on TV. But the reality of the situation is, if you're only going to go for the index, you might as well get the lowest cost version of the index you can get. But then what we're finding is that people are going for the index. That is quite a strong development in the industry. But then they're also taking select funds to try and outperform the index. I feel that that's kind of where the industry is going.
It's been great talking to you, Karl. Thanks very much.
Thanks, Alan. Thank you.